If someone walked up to you today and offered you a guaranteed 20% annual return on your money, you'd probably think they were running some type of scam, right? But that's exactly what you get when you pay off credit card debt that's charging 20% interest. Welcome to Everyone's Talking Money, where we get brutally honest about money, mindset, and making life richer. So I just turned 40, and let me tell you, money has had a front row seat at every single chapter of my life. The wins I'm proud of, the late night math sessions that kept me awake at 2 a.m., the what was I thinking mistakes. Yeah, all of it. And you know what's funny about turning 40? Everyone expects you to have some kind of midlife crisis. Buy a sports car, get a dramatic haircut, suddenly decide you need to climb Mount Everest. And even as we've discovered in past episodes, starting a business is the new midlife crisis. But here's what actually happened. I got clarity, crystal clear, no BS clarity about what really matters with money. And to mark this milestone birthday, I've decided to do something big. I'm sharing 40 money lessons at 40. The real stuff I've learned from my own experiences, from working with clients, and from watching how money can either build freedom or cause total chaos. In episode 1, we talked mindset, money as a tool, not the goal. In episode 2, we laid the foundation with habits and cash flow systems that actually work. And today, in episode 3, we're talking about the lessons that protect what you're building: debt elimination, credit mastery, and insurance. Now, I know this is not the flashy side of money. No one's throwing me a 40th birthday party with a cake shaped like an umbrella insurance policy. Trust me, I checked. And apparently that's not a thing. But here's what I do know at 40. If you don't get this protection stuff right, it doesn't matter how much you make or how smart you are with investing. One crisis, one accident, one 24% credit card bill that spirals out of control, and the whole thing can come crashing down like a house of cards in a tornado. That's why these lessons matter. They're not about living in fear or being paranoid about worst case scenarios. They're about freedom, real freedom. Because at 40, I can tell you, money confidence doesn't come from never messing up. It comes from knowing you're protected when you do. If you're just starting in my money lessons now, go back and listen to the previous 2 episodes. I'll be right here waiting for you. So grab your coffee, settle in, and let's dive into the protection lessons that can literally save your financial life. Lesson 17, pay off high interest debt first. It's a guaranteed return. So let's start with something that sounds boring, but is actually revolutionary: paying off high interest debt first. If someone walked up to you today and offered you a guaranteed 20% annual return on your money, you'd probably think they were running some type of scam, right? But that's exactly what you get when you pay off credit card debt that's charging 20% interest. Think about it. No investment in the world reliably returns 20% annually. The stock market averages around 10% long term, and that comes with risk. Real estate, maybe 8 to 10% if you're lucky. Bonds, we're talking 3, it may be 5% these days. But paying off that credit card, that's a guaranteed 20% return. Your dollar is working so much harder getting rid of credit card debt than it is sitting in your savings account or even being invested. And you get that guaranteed 20% return with no market volatility, no economic uncertainty, no past performance doesn't guarantee future results disclaimers, just pure mathematical certainty. Think about it. If you have about $15,000 spread across 4 different credit cards, making minimum payments while simultaneously trying to invest in your 401k because someone told you you needed to start investing. Let me walk through the math. You are essentially borrowing money at 22% interest to invest it to earn maybe 7%. That's not being smart with your money. It's expensive gambling. So, what's the answer? Maybe it is pausing your contributions to your 401k. And yes, you are missing out on the employer match for a few months, which obviously would hurt. But throwing everything at that high interest credit card debt and getting rid of it, and more importantly, never building it back up, may be a better investment. When it comes to getting rid of credit card debt, there are two options. First, the snowball method, which you pay towards your lowest bill or lowest balance first. So you pay towards your lowest balance, you pay minimum payments on everything else, and pay towards your lowest balance. And then you get rid of that. And then when you get rid of that, you take whatever extra you were paying towards that lowest balance credit card and pay it towards your next lowest balance, and so on and so forth. That's the debt snowball method. Or many people like the debt avalanche method, where you pay off your highest interest rate first. So don't worry about your balances. You pick the debt with the highest interest rate and get rid of it, because that may actually have your dollar working harder for you versus the debt snowball method. So that 24% store credit card with the $800 balance needs to go before that 12% interest credit card with the $5,000 balance. So here's your action step. Right now, list all of your debts with their interest rates. That's the big one. It may require you to do a little bit of research, but not the balances, the rates, and attack the highest debt interest rate first, regardless of the balance size. Math is your friend in this situation. Now, here's what's sneaky about debt. It often doesn't show up looking like a problem. It shows up wearing a disguise, whispering sweet lies in your ear about what you deserve. And that leads us to one of the most dangerous financial traps I know, which is lesson 18. Avoid lifestyle creep. Debt often comes disguised as, I deserve this. Lifestyle creep is the silent wealth killer. It's got the best marketing department in the world. It doesn't knock on your door announcing itself. Instead, it slides in smooth as silk, whispering things like, you work so hard, and you've earned this, and just this once, it'll be fine. Here's how it works. You get a raise, so you upgrade your apartment because you deserve better living conditions. A bonus comes through. Time for a nicer car because you've worked so hard for this money. Your income goes up by 20%, but somehow your expenses go up by 25 and you're left wondering where all the money went. I watched this happen to my friend in real time. She got promoted from making $85,000 a year to $105,000 a year, a $20,000 raise that should have been life-changing. Within 6 months, she upgraded her apartment, leased a BMW, started shopping at Whole Foods exclusively, and picked up a $200 a month gym membership at one of those fancy places with eucalyptus towels. A year later, she was more stressed about money than even before her promotion. She was making $20,000 more, but somehow had less money at the end of the month. The lifestyle upgrades had eaten her entire raise plus some. The I deserve it mindset is particularly dangerous because it feels so reasonable. You do work hard. You should enjoy some fruits of your labor. But here's the trap. If every increase in income leads to an equal or greater increase in spending, you're just running faster on the same financial treadmill. And it's so easy to fall into these traps. We can do it any time. You get a raise and you start not worrying about money as much. You're not tracking your spending as much as you did. And that's where those slow leaks occur. Here's the antidote to lifestyle creep. When your income increases, get yourself a treat. Everyone deserves a little, I deserve this, I work hard treat, but it's a one-time thing. Ideally, I want you to save every dollar your income is increasing by. Because remember, a $20,000 raise doesn't mean there's $20,000 more in your pocket. Uncle Sam is taking a big chunk of that too. Your 401k may be getting a little bit more if everything's based off of percentages. So now it's 7% of a larger amount. So I want you to get yourself the treat, because if you don't, you'll start to feel resentful of your raise. But after that treat, I want you to live on that same amount of income that you were making prior to the raise. And then start to notice how much more money you end up with in your checking account each month. And get an average. And again, like I said last episode, after something major happens, give yourself 3 months for things to shake out. So 3 months later, I want you to look at on average how much you're spending and how much less it is than your new income. And I want you to save the difference. Move it into a savings account, move it into an investment account, but get it out of your checking account. You can even move it to a vacation fund. I don't care. Just get it out of your checking account, put it somewhere else. That is how you avoid the lifestyle creep, because now you're saving that extra cash. And yeah, you may use it on a vacation, but isn't that fantastic that now you can pay for your vacation as a result of your higher income versus putting it all on the credit card? So look at your spending over the past year. Has your income increased? Has your lifestyle also increased? And take your action step. The next time your income increases, a bonus, a raise, side hustle, windfall, whatever it is, commit to saving at least half of that increase before making any major lifestyle changes. And speaking of debt disguises, let's talk about the biggest one of all, the idea that carrying credit card balances is somehow normal or even good for your credit score. This myth has probably cost Americans more money than any other financial misconception. So this leads us into lesson 19. Pay off credit cards in full every month. Interest is the wealth killer. Let me be crystal clear about something. Credit cards are financial tools, not loans. Used properly, they give you convenience, rewards, and fraud protection. Used improperly, they're wealth-destroying machines that will eat your future alive. The magic number with credit cards is zero. Zero balance carried from month to month. If you can't pay the full statement balance, you can't afford the purchase. It's really that simple. But somehow we've been sold this idea that carrying a balance is normal or even beneficial for your credit score. This is expensive nonsense. Credit card interest compounds daily, making every purchase you can't pay off immediately more expensive than you think. So let me tell you about my friend Sarah. Smart woman, good job, making $75,000 a year. But she was carrying about $8,000 in credit card debt across 3 cards, making minimum payments because someone told her it was quote unquote building her credit. Sarah was paying about $200 monthly in minimum payments, but only $50 of that was going to the principal. The other $150, pure interest. At that rate, it would take her over 30 years to pay off the $8,000, and she would pay over $20,000 in total. Sarah's not building credit. She's building wealth for credit card companies. And guess what? Those points that she's also getting on her credit card, she could have paid for those flights and those points tenfold. Here's the truth about credit scores. They care about utilization, not carrying balances. Using 10% of your available credit and paying it off in full every month will give you a better score than carrying balances and paying interest. The mental shift happened for Sarah when I reframed it. Every dollar of interest you pay is a dollar that can't go toward your goals. You're literally paying credit card companies for the privilege of having less money. Sarah created a plan where she stopped using the cards completely and threw every extra dollar at the balances. Within 14 months, she was debt-free. Her credit score actually went up, and she suddenly had $200 monthly for saving and investing instead of interest payments. Now, if you're already carrying balances, here's your action plan. Stop using the cards immediately. I don't care if they're offering 5% cash back on groceries. You can't cash back your way out of 22% interest. Cut up the cards if you have to. Is it extreme? Maybe. Is it effective? Yes, it is. Then attack the balances aggressively. Every bonus, every tax refund, every dollar you could squeeze from your budget goes to that balance until they are gone. Here's the hard truth. Your future self is paying a premium for everything you buy today when you carry credit card balances. That $50 dinner easily becomes a $75 dinner when you factor in interest over time. So log into your credit card accounts right now and look at your balances. If there are any balances being carried month to month, those are financial emergencies. Treat them like the wealth destroying fires that they are. Now, while we're talking about credit, let's talk about protecting it because identity theft is real. It's growing. And those credit monitoring services you see advertised everywhere, they're basically telling you about the fire after your house has already burned down. But there's a better way, which is lesson 20. Freeze your credit to prevent identity theft. Credit monitoring tells you after someone has stolen your identity. Credit freezing prevents them from stealing it in the first place. And here's the kicker. Freezing is free, easy, and more effective than any paid monitoring service. You hear about it all the time. Someone who discovered that a bad guy had opened up 5 different credit accounts in their name. The cleanup takes months. It costs thousands of dollars in attorney fees, and it can prevent you from buying a house because your credit looks like it got caught in a disaster zone. Meanwhile, I'd frozen my credit years earlier after reading about it in some random finance blog. And it took like maybe 20 minutes total to freeze it with all 3 credit bureaus. So when someone tries to open an account in my name, they literally can't because my credit is frozen solid. Here's how it works. When your credit is frozen, potential lenders can't access your credit report to approve no accounts. No access, no approval, no identity theft. It's like putting a deadbolt on your credit. Well, what happens if you need to apply for credit, you ask? Easy. You temporarily unfreeze it for a specific period, apply for what you need, and then refreeze it. It takes seconds to freeze and unfreeze your credit. And I've unfrozen my credit 3 times in the past couple of years. Once to refinance my mortgage, once to get a new car loan, and once when I was shopping for a better credit card. Each time, I unfroze it for a week, did my business, and locked it back down. The peace of mind with freezing your credit is incredible. I don't worry about data breaches anymore. My information has probably been compromised a dozen times. Everyone's has, but it doesn't matter because my credit is locked down tighter than Fort Knox. So go to the websites for all 3 credit bureaus, Experian, Equifax, and TransUnion, and freeze your credit today. Right after this episode ends, your future self will thank you. Now, let's shift gears from protecting your credit to protecting something even more valuable, your ability to earn money in the first place. Because here's something people never think about. Lesson 21. Keep disability insurance. Your income is your biggest asset. Most people insure their stuff, their cars, their homes, their phones, their jewelry. But what about the most valuable asset they own? Their ability to earn income. That's completely unprotected. Let me put this in perspective. If you're 30 years old making $120,000 a year, your future earning capacity is worth nearly $5 million over your working life. Your house might be worth $300,000, your car may be worth $25,000, but your paycheck, that's a multi-million-dollar asset just walking around uninsured. Disability insurance protects that income stream if illness or injury prevents you from working. And before you think, that won't happen to me, let me share some statistics that'll wake you up. 1 in 4 workers will become disabled before they retire. 1 in 4. It's not just major disabilities either. Stress, depression, back problems, cancer, autoimmune conditions, all sorts of things can impact your ability to work, even temporarily. So let's think about someone we know. Let's just call her Sarah. She is a successful interior designer making about $120,000 a year. Sarah insures her laptop, her studio space, her samples, and her supplies. She insures everything except her ability to design and manage projects. Then one day, she slipped on a job site and broke her leg, requiring multiple surgeries, sitting in a wheelchair. She wasn't able to drive. She couldn't work for 9 months because, one, she physically couldn't drive herself to work. She also did not know how she was going to be feeling day by day, and she wasn't able to risk bringing on new clients and unable to provide them the service that they're paying for. So she had no income, bills piling up, and nearly losing everything. Insuring a paycheck does not occur to most people. Most people think disability insurance is just for people in construction or risky jobs. But Sarah's story has a happy ending. She eventually recovered and went back to work. But those 9 months without income can nearly bankrupt you. What would you do right now if you weren't able to earn money for 9 months? Now, we learn the lesson and carry disability insurance, and it's the smartest money she can spend. If you're employed, many employers offer basic disability insurance, but it's often insufficient. It might cover 60% or so of your income and only for a limited time. If you're self-employed like Sarah, you're completely on your own unless you buy your own policy. Here's what to look for. Coverage that replaces at least 60 to 70% of your income, benefits that last until retirement age if necessary, and own occupation coverage if possible. Own occupation means if you can't do your specific job, say you're a surgeon who injures their hands, you get benefits even if you theoretically could do other work. Just think about jobs that require your hands. And if you weren't able to do that, how horrible would that be? So disability insurance protects you if you're not able to use your hands, for example. Is disability insurance exciting? No, it is not. Do I look forward to paying premiums for my disability insurance? No, I do not. Also, even think about me. If I lose my voice for even a few days, I'm not able to work. I'm not able to put out content and speak to all of you. So it's not crazy to insure the thing that gives you the means to be able to work. But every month when I pay my premiums, I'm paying for peace of mind. I'm protecting my family's financial security, even if something happens to me. So if you couldn't work for 6 months starting tomorrow, how would you pay your bills? Check out what disability coverage you have through your employer if you're employed. If it's less than 60% of your income or only covers short-term disability, look into supplemental coverage. If you work for yourself, check out disability coverage now. If you are solely responsible for your income, if you're unable to work, what would that mean for your household? Now, disability insurance protects your income. But as your wealth grows, you need to think about protecting your assets too, because the more you have, the bigger target you become. Which brings us to a type of insurance most people have never heard of, but absolutely should consider. Lesson 22. Don't skimp on umbrella insurance once your net worth grows. As your net worth grows, you become a more attractive target for lawsuits. It's not paranoia, it's math. The more assets you have, the more someone can potentially take from you in a lawsuit. Car accident where someone seriously gets hurt? Lawsuit. Someone slips and falls on your property? Lawsuit. Your teenager posts something stupid on social media that goes viral for all the wrong reasons? Believe it or not, lawsuit. My neighbor was telling me about something that happened to them. Their teenage son rear ended a luxury car. The other driver claimed injury and sued for $800,000. Without umbrella insurance, my neighbor would have had their life savings wiped out, including their retirement funds. Umbrella insurance provides liability coverage beyond what your home and auto policies offer. Think of it as a safety net that catches the really big financial falls that could otherwise destroy your wealth. And here's the beautiful part. It's incredibly cheap. I pay about $250 a year for $1 million in coverage. Compare that to the potential cost of defending a lawsuit, which can easily run $50,000, $100,000 even if you win. It's obvious protection. The coverage kicks in after your regular insurance levels are exhausted. So if your auto policy covers $300,000 per accident and you're sued for $800,000, your auto insurance pays the first $300,000 and the umbrella picks up the remaining $500,000. Most insurance companies require you to have certain minimum liability limits on your auto and homeowners policy before they'll sell you umbrella coverage, which actually makes everything work better together. So if your net worth is sitting at $250,000, $300,000, it's worth the extra 20 minutes to call your insurance agent about umbrella coverage. It's one of the best investments you can ever make for protecting what you've built. And this brings us to the overarching principle about all insurance, which took me way too long to understand and appreciate. Lesson 23. Insurance isn't exciting, but it's essential. Insurance is the broccoli of financial planning. Nobody gets excited about it, even when it's covered in cheese and goodness. But nobody wants to talk about it at parties. But it is absolutely essential for your financial health. For years, I viewed insurance as a necessary evil. Money going out the door every month for something I hoped I never used. And honestly, it felt like throwing money away, especially when I was young and invincible and couldn't imagine anything bad happening. But then bad happens. It's life. Medical emergencies, car accidents, home break-ins, a liability scare. Suddenly, insurance went from being an expense to being a lifeline. Here's how I think about insurance now. I'm paying a small, predictable amount to avoid a large, unpredictable loss. I'm transferring risk from myself to an insurance company, and that transfer is valuable even if I never file a claim. Think about it like wearing a seatbelt. You don't put on your seatbelt expecting to get in an accident. You put it on as protection in case something unexpected happens. And you don't feel like you wasted your seatbelt if you arrive safely at your destination. No one ever says, man, I really wish I didn't wear my seatbelt for that car ride. It's the same thing with insurance. You're not buying it hoping for a disaster. You're buying it so that if disaster strikes, it doesn't destroy everything you've worked so hard to build. The best case scenario when you have insurance is that you paid for it and you never used it, right? I mean, think about it. Does anyone ever say, I am so glad I had to have my umbrella policy kick in? So again, reframe your thinking about insurance. The best case scenario is I paid for it and I never used it. It is not. I chose not to get it and I wish I did. The time to get insurance is when you don't need it. Once you do need it, it's often too late or too expensive. The person whose house just flooded can't buy flood insurance for that flood. After you have a heart attack, you can't buy insurance for the medical bills you just had from being in the hospital. Here's a type of insurance most people need: health insurance, auto. We're also legally required to have that. Homeowners or renters, which protects your stuff and liability. Disability protects your income. life insurance if people depend on your income, and umbrella insurance once you have assets to protect. Action step: do an insurance audit. When was the last time you reviewed your coverage? Are there gaps? Are you paying for coverage you don't need anymore? Make sure your protection matches your current life situation. All right, let's bring this home. Today, we covered 7 lessons that can literally save your financial life. Why paying off high interest debt is the best guaranteed investment you'll ever make. How lifestyle creep sneaks in wearing the disguise of, I deserve this, and how to stop it before it stops you. Why the magic number with credit cards is always 0, not for your credit score, but for your wealth. How a free credit freeze beats fancy monitoring services at actually preventing identity theft. And why your paycheck is your biggest asset and how disability insurance protects it. How umbrella insurance shields everything you've built when life gets messy and litigious. And why boring insurance is actually the backbone of real financial peace of mind. Here's the truth I know at 40. Money isn't just about making it, it's about keeping it and protecting it so you can actually use it to live a life that feels rich in every sense of the word. These protection strategies might not be Instagram worthy, but they're wealth preserving. They're the difference between building something that lasts and building something that can be wiped out by one bad break. Next episode, we're moving from protection to growth, investing and retirement planning. The part that feels exciting, sometimes intimidating, but ultimately is how you turn your protected foundation into lasting wealth. If today's episode struck a chord, share it with someone who needs to hear these truths, and let's keep this conversation going. Because at 40, I can tell you with certainty, the goal isn't just to get rich. The goal is to build wealth you can keep, protect, and use to create the life you actually want. I'll see you next time to continue my 40 lessons at 40. And always remember, money is a tool to live life on your terms. Build it and also protect it. I'll see you next time.